It's the speed that bothers me. I've been sitting here staring at the 4-hour chart on the COMEX feed for, I don't know, maybe 2 hours now, just watching the volume profile try to resolve what just happened, and it doesn't look like a market correction. Usually when you get a pullback, even a violent one, even a crash, there is a texture to it. You see buyers step in, you see a little bit of a fight at the support levels, you see human psychology playing out in real time, greed fighting fear. But what happened this morning, this wasn't humans trading. We went from a record high, touching $121.64, a number that frankly seemed impossible 3 weeks ago, to $73.40 before most people had even finished their morning coffee. That is a 16% erasure of capital in hours. And if you're just reading the headlines, if you're just scrolling through the news feed on your phone, you're seeing the easy answer. They're telling you it's about Kevin Warsh. They're telling you that because Trump nominated a hawk to the Fed, the dollar spiked and silver collapsed. Cause and effect. Simple. Neat. And look, there is truth to that. The DXY did rip higher. The algorithms read the headlines. But I've been trading precious metals since the late 90s, and I can tell you that a Federal Reserve nomination does not cause a $48 air pocket in a $1 trillion market. That's not how liquidity works. That's not how price discovery works. Something else broke. I want you to look closely at the timestamp of the first major sell order. It hit the tape exactly 3 minutes before the official press release went out. That's not speculation, that's just looking at the order book. Someone wanted out. And not just out, they wanted out at any price. When you see a move like this, where the bid stack just evaporates, where the price is falling through the floor and there is zero liquidity to catch it, you are not watching a market reacting to news. You are watching a structural failure. And the reason I'm recording this, the reason I'm not just turning off the screens and walking away, is because of what happened at $75. See, usually after a 16% flush, you get the bounce, the dead cat. The shorts cover, the bargain hunters step in, and you get that relief rally. We didn't get that. We just stopped. The market is sitting there, hovering in the low 70s, heavy, like it's waiting for permission to move again. And that scares me more than the drop, because it tells me the selling isn't finished. It tells me that what we just saw wasn't a panic, it was a mechanism that was triggered by the price hitting $121, and a mechanism that is still running in the background right now. Everyone is comparing this to the Hunt brothers in 1980. They're saying the bubble popped. I think that's lazy analysis. I think what we're seeing is actually something much more modern and much more dangerous. It's about the plumbing of the futures market itself. It's about who is actually holding the bag when the leverage gets pulled. So put the headlines aside for a second. Forget the politics. I want to walk you through the anatomy of this crash, tick by tick. Because if you are holding silver, or if you were thinking about buying this dip, you need to understand why the floor at $70 might not be made of concrete. It might be made of glass. And you have to understand, the people who got hurt this morning aren't the ones you usually hear about. It wasn't the big macro funds. They've been hedging this position since we crossed $100. No, the people who got carried out on a stretcher today were the breakout buyers, the retail traders, the late-to-the-party momentum chasers, who looked at the chart 3 days ago, saw that vertical green line pointing to the moon, and thought, this is it. This is the super cycle. I can see their footprints in the open interest data. And this is where the story gets ugly. If you look at the COMEX commitment of traders reports leading up to this week, and I know, the data is always lagged. It's 3 days old by the time we see it. But the trend was undeniable. We saw a massive spike in non-commercial long positions right as we broke $115. That is fancy talk for speculators using borrowed money. These aren't industrial users buying silver for solar panels or electronics. These are people betting on price, and they were betting with leverage. See, when you buy a futures contract, you're not putting up the full value. You're putting up a fraction, a margin. And at $120 an ounce, the leverage ratio was getting ridiculous. People were controlling massive amounts of silver with very little actual cash collateral. So when the price ticked down just 2% on the initial Warsh rumor, it didn't just hurt their profit, it threatened their solvency. Now, let's look at the contradiction. This is the part that isn't sitting right with me. The headline narrative is dollar up, silver down. Okay, let's test that. When the Kevin Warsh news broke, the US dollar index, the DXY, rallied about, 80 basis points? Maybe almost a full percent? That is a strong move, sure, but historically, a 1% move in the dollar usually corresponds to maybe a 2, 3, maybe 4% move in silver. Inverse correlation, right? We dropped 16%. The math doesn't add up. You don't get a 16% liquidation event from a 1% currency move unless the market is structurally broken underneath. The reaction was disproportionate. It was exponential, not linear. That tells me the dollar was just the pin. The balloon was already filled with dynamite. And here is the specific data point that nobody's talking about yet, but I guarantee you it will be in the papers tomorrow. Look at the volume spike at 10:15 a.m. We saw 3,000 contracts hit the bid in a single second. That is not a repricing, that is a forced exit. That is an algorithm detecting a margin breach and blindly selling at market price to cover the broker's risk. This is where it stops making sense if you think this is just about interest rates. If this were just about the Fed, you'd see gold down 5 or 6% too. But gold held up relatively well. It was down, sure, but it wasn't a crash. It was a correction. Silver detached. Silver went rogue. Why? Because the leverage in silver was higher. The dumb money, and I hate using that term, but it applies here, was concentrated in silver because it's the cheaper unit price. It's the people's money, and the volatility attracts the gamblers. So what we witnessed wasn't a valuation change. It was a margin cascade. Price drops, broker demands more cash, trader doesn't have it, broker sells position, price drops further, next trader gets the call. Rinse and repeat. It's a feedback loop. And once that loop starts, fundamentals don't matter. Kevin Warsh doesn't matter. The only thing that matters is liquidity. But here's the catch. Here is the thing that is keeping me glued to this screen. Usually, a margin flush cleans out the weak hands in about an hour. It's violent, it's messy, and then it's over. You get a V-shaped recovery. But look at the chart right now. We are 4 hours past the low and we're dragging along the bottom. We aren't bouncing. That implies something else is happening. That implies that the smart money, the commercials, the banks, the guys who usually step in to buy these crashes, they are stepping back. They are letting it burn. And you have to ask yourself why. Why aren't they buying silver at a 40% discount from the highs? I think I found the answer in a notice that went out from the CME group quietly this afternoon. It's a boring PDF, mostly legal jargon, but if you scroll to the bottom, there's a line about maintenance margins. And that is the smoking gun. The document I'm talking about is a margin hike notification. When markets go vertical, when you get that parabolic shape that looks like a rocket taken off, the exchange, the CME, gets nervous. Their job isn't to make sure you get rich. Their job is to make sure the casino stays open. They need to ensure that if the price crashes, the losers can pay the winners. So when volatility explodes like it did this week, they change the rules. They raise the performance bond requirements. In plain English, they made it more expensive to hold a position. And this is the mechanism that nobody is discussing on the news right now. They're talking about the Fed, they're talking about inflation, but the real assassin today was a boring administrative decision to hike margin requirements by, if my math is right, about 18% overnight. Think about what that does to a trader who's already underwater. You're sitting there, long silver at $110, $115. You're already bleeding because of the morning sell-off. Then suddenly your broker pings you. They don't just need you to cover the loss, they need more cash just to keep the trade open because the exchange raised the ante. You don't have the cash, you're fully deployed. So what do? You don't have a choice. You sell. You sell into a falling market, and your selling lowers the price, which triggers the guy next to you who also gets a margin call, and he has to sell. It's a forced feedback loop. It's mechanical. It has no emotion. It just hunts leverage until there's no leverage left to hunt. And that brings me to the signal that everyone is ignoring. I'm looking at the spread between the spot price, the paper price we trade on screens, and the physical price of silver coins and bars at the big dealers. Usually in a crash, these diverge. The paper price collapses, but the physical price stays high because real people want the metal. We call it premium expansion. But today, the premiums are collapsing too. That is terrifying. That tells me that this isn't just paper speculators getting washed out. It suggests that the physical buyers, the stackers, the long-term holders are exhausted. They bought at $90, they bought at $100, they bought at $110. They are tapped out. There is no white knight coming in to scoop up physical silver at $73 because everyone who wanted silver already bought it on the way up. The market is saturated. This is the difference between a dip and a trend change. A dip is when price falls but demand is waiting below. A trend change is when price falls and finds nothing, just air. Now, I want to pause for a second. I want to step back from the ledge because whenever you get this bearish, whenever the data lines up this perfectly for a crash, you have to ask yourself, what am I missing? You have to stress test your own thesis. So here's what would invalidate everything I just said. Here is the scenario where I'm completely wrong and silver rips back to $100 by Friday. If we see a major industrial player, I'm talking a Samsung, a Tesla, a massive solar manufacturer, step in and announce a strategic reserve purchase, the game changes instantly. See, the industrial side of silver is opaque. We don't see their inventory levels until they report earnings, which is months too late. If the supply chain for electronics is actually tighter than we think, if they're terrified of running out of silver for their chips and panels, they won't care about the chart. They won't care about Kevin Warsh. They will panic buy at any price to keep their factories running. If that happens, if we see physical delivery demand spike on the COMEX, meaning people are asking for the actual bars instead of cash, then this entire margin crash thesis is garbage. In that scenario, the price is fake, and the explosion upwards will make the last rally look like a joke. I'm watching the exchange for physical volume like a hawk for exactly this reason, but I have to be honest with you, I haven't seen it yet. Not today. Today, the industrial buyers are sitting on their hands. They're waiting for $60. And that leads us to the binary setup we are facing right now. We are standing at a crossroads, and the market is going to pick a path in the next 24 hours. Path 1 is the consolidation trap. The price hovers here between $70 and $75. It looks safe, it looks like a floor, volatility dies down, the news cycle moves on to the next crisis, and retail traders start nibbling again thinking the worst is over. This is the dangerous path, because usually consolidation after a crash isn't a base, it's a pause. It's the market taking a breath before the next leg down. It lures people in, grinds them sideways for a week, and then breaks the floor. Path 2 is the capitulation flush. We don't wait. We break $70 tonight, we go straight down to the 200-day moving average, which is sitting way down near $55, by the way. It sounds extreme, but that's where the long-term structural support actually is. If we take that path, it will be brutal, it will be fast, and it will be the buying opportunity of a lifetime. I know which one I'm hoping for. I'd rather have the pain over with. I'd rather see the flush. But looking at this volume profile, looking at how heavy this market feels, I think we might be stuck in the trap. I think we're going to bleed slowly, and that is much harder to trade because the Warsh Shock wasn't just about rates. It was a signal that the easy money era is officially over, and silver loves easy money. Without it, silver has to stand on its own merits as an industrial metal, and at $73, I'm not sure the industrial math works yet. So what happens next? This is where the psychology shifts from panic to despair. And despair, oddly enough, is where you find the truth. Despair is clarifying because it strips away the story. When you are down 16% in a day, you stop caring about the narrative of the dollar or the election or the geopolitical tension in the Strait of Hormuz. You just care about the math. And the math right now is pointing to a very specific, very painful scenario that I think most people are completely unprepared for. We are entering what I call the volatility compression phase. This is the trap I mentioned. See, human nature wants V-bottoms. We are wired to want the immediate gratification of a sharp rebound so we can feel smart again. We want to buy at $73 and see $90 by Tuesday. But the market exists to frustrate the majority. And right now, the majority is praying for a bounce. That means the market is unlikely to give it to them. If we stay in this range, bouncing between $70 and $78, that's not stability, that's distribution. That's the smart money using the remaining retail optimism to offload the rest of their long positions without crashing the price further. They feed the bid little by little. They let you think the bottom is in. They let you average down. And then, once they are fully out, once the bag has been successfully transferred from the institutions to the public, that is when the floor drops out. So here's the roadmap I'm using, and I'm not writing this in pen, I'm writing it in pencil, because we have to be adaptable. But this is the structure. If we break below $68.50, which is the low of the flash crash wick, that's the signal that the distribution phase is over. At that point, there's no technical support until the 200-day moving average, which is sitting way down near $54 or $55. I know that sounds impossible from here. I know $55 sounds like a number from a different era. But remember, we were at $55 just 4 months ago. The right up was vertical, the right down can be just as fast. If 68.50 goes, the algorithmic supports vanish, and we're looking at another 20% haircut. However, there's the other side, the invalidation side. If we can somehow reclaim $84, and I mean a daily close above $84, not just a wick, then the structure changes. $84 was the breakout level from last week. It was the ceiling that became the floor. And now it's the ceiling again. If we get back above that, it proves that there's real aggressive demand willing to fight the Fed. It proves that the Warsh Shock was a one-day panic, not a regime change. But here is the hard part, the part that nobody wants to hear. The space between $68 and $84, that is the kill zone. That is where accounts go to die. It's choppy, it's random, and it's designed to chew up your capital with false breakouts and false breakdowns. So what am I doing? I'm doing the hardest thing a trader can do. I'm sitting on my hands. I'm doing absolutely nothing. I'm not buying this dip. I'm not trying to be a hero and catch the falling knife. The risk to reward ratio here is terrible. If I buy at $73, my upside to the first resistance is maybe 10%. My downside to the structural support is 25%. The math doesn't work. The casino has the edge right now. I'm watching the miners, the silver mining stocks. They usually lead the metal. If the miners start rallying while silver is still falling, that's a bullish divergence. That's a signal that the insiders are positioning for a turn. But look at them today. They're decimated. They're down more than the metal. They're not signaling a turn. They're signaling that earnings are going to be a disaster. And I want to address the long-term holders for a second. The people who aren't trading futures. The people who have a stack of coins in a safe. You're going to feel pressure in the next few weeks. You're going to see headlines calling this the end of the silver mania. You're going to see analysts downgrading their targets. That's part of the cycle. It's designed to make you question your conviction. But remember the fundamental reality. The solar panels, the electric vehicles, the batteries, they don't care about Kevin Warsh. They need the metal. The industrial deficit hasn't changed. The only thing that changed is the paper premium. So, if you are a long-term holder, this crash is noise. It's expensive noise, it's painful noise, but it's noise. But if you are a trader, if you are using leverage, this crash is a siren. It is telling you that the rules have changed. The liquidity tide is going out, and you do not want to be the one swimming naked when the water level drops. I'm looking for one specific thing to get me interested again. I'm looking for capitulation volume. I want to see a day where the price drops 10%, but the volume is double what we saw today. I want to see pure panic, because panic is where the bottom is. Today wasn't panic. Today was forced liquidation. There is a difference. Panic is emotional, liquidation is mechanical. We need the emotion to wash the market clean. Until I see that, or until I see it close above $84, I am a spectator. I'm keeping my powder dry. Because the worst mistake you can make in a volatility shock is to assume the first move is the last move. Usually, it's just the opening act. So here's the question I want you to answer honestly in the comments, because I need to gauge the sentiment in this room. Do you believe that the industrial demand, the physical need for silver in 2026 tech, is strong enough to put a hard floor at $70, or was the run to $120 purely a paper derivative bubble driven by speculation that just popped? I need to know if you think we are looking at a discount or a deception, because your answer determines whether you are a buyer or a seller here. I'm digging into something for the next update that might give us the answer. I've been tracking the eligible versus registered inventory levels in the COMEX vaults, and there was a weird transfer yesterday, a massive movement of metal from eligible to registered right before the crash. It looks like someone was taking metal off the market precisely when the price was peaking. It's a pattern I haven't seen since 2021. I need to verify the warrant numbers, but if it means what I think it means, the supply squeeze might be real, even if the price is crashing. I'll have those charts ready for you once the weekly report drops. Stay safe. Watch your leverage. Don't let the volatility bait you.